Hello and welcome to the Real Solutions Seminars, Credit and the Interest Insomniac, Using Credit Wisely from Debt Reduction Services and the National Financial Education Center. My name is Todd Christensen and I am the Director of Education here, and I'll be your presenter and host today. To begin with, let me just give a few items of information. You will need to take some notes today, particularly note down the passcodes. There will be 3 passcodes given throughout this presentation. If you want to take the corresponding quiz for credit, you will need to write those passcodes down just as they appear on the presentation. Okay. Normally, we will ask our people coming to our classes to silence their cell phones and to let them know where the water and restrooms are. Of course, on a webinar, we do suggest that you get in a place where you can minimize the interruptions, but in this case, you can just press the pause button whenever you like and come back to it shortly or at another time or day, and just remember where you were, how far along you are in the presentation. You can get yourself back there. All right, we are a nonprofit credit counseling agency. Offices nationwide from Alaska to New York. We have been around since '96, and we are an organization of financial educators and counselors that strive to help individuals improve their finances from the fundamentals of budgeting and spending to credit and debt. All right, here's what we're talking about today. The question is, what is credit? A lot of people have some ideas about what credit is, and some of those ideas are actually false. So we'll talk about that. We'll talk about the specifics of what's on a credit report, what is a credit score, what's the difference, what goes into a score, what's on the report. We'll talk about the power of compounding interest, and we'll finish off the presentation talking about how to use credit, particularly credit cards, properly and wisely. Okay, so this is a question that we ask wherever we go in our presentations, and we go into high schools, and we get some really interesting questions or answers to this question. What is credit? What is the first thing that comes to your mind when you hear the word credit? And a lot of people will usually say things like money or loan or debts or card. But really, and here's some of the other things that come up that we've actually heard. We've heard it. Some people say, well, it's a status symbol. It's a free money. It's a free loan. Or it helps me buy what I can't afford. Think about that. A credit card helps me buy what I can't afford. If you can't afford it right now, you probably can't afford it with a credit card either. It's just putting off the inevitable. We've even heard people just call it plain out evil. So these are things that come up when we're talking about, we're trying to figure out what it is. Credit is not money. When you say the word credit, it's not money. And you might say, well, it's a loan for money. But credit itself is not a loan for money. Credit is a tool that we use when we are looking for a loan. But here's 4 things. We want to talk about what credit actually is. 4 things. First of all, it's a privilege, not a right. We do not have a constitutional right to carry 8 credit cards in our wallet or to have 8 credit accounts open on our credit report, which, by the way, is pretty much the average in this country. We do not have a right to sue a company if they feel we are not a good credit risk. Obviously, if we are denied credit for discriminatory reasons, that's different. But we do not have a right to carry a credit card or to get a loan by using our credit. It is a privilege. And just like any other privilege, it's something that generally has to be earned. And if we make a mistake or if we slip up, then we can lose that privilege. That's what good credit is. It's also recognition. And by recognition, I'm talking about capability and responsibility. I'm not talking about, yay, look, I got a credit card. I'm talking about if an organization, if a creditor extends a line of credit to you, they're recognizing generally 2 things, that you have, 1, the capability to pay back that loan, so that you have some sort of income, and in some cases, the collateral that they could repossess. 2, that you have you are a responsible person. That even if you have the ability, even if you have an income sufficient enough to pay back the loan, if you don't have personal responsibility to pay it back, it doesn't matter. They want somebody who has both the capability and the responsibility. One without the other doesn't work. So that's what I'm referring to when we talk about recognition. The next one is, think of it as an agreement, a binding agreement. It is a promise. It's a legal promise, and that's a lot of people don't realize when they swipe that credit card at the store or at a fast food restaurant or whatever it is, at the 99-cent store, that they are actually taking out a loan. Each swipe of the card is a legal agreement or a loan. So think about it. When the reason I put promise there is we ought to think of our credit as a promise this way. If you were a promise breaker, generally, if you broke your promises to your friends and to your close and to your family members, you would soon have a reputation that you do not keep your promises. It is very much the same thing when it comes to our credit, because institutions that are in the business of lending money will find out who are the promise keepers and who are the promise breakers. If we do not pay back a loan as we have promised, well, then it gets reported that that creditor who we've broken our promise to, they will report that to the credit bureaus. We'll talk more about this, who then keep track of all that sort of information and share it with others, so that we get a reputation of being either a promise keeper or a promise breaker on our credit report. So think of it that way, and some people will refer to this as character. But what credit really is, think of it as a tool. Just like a hammer is a tool for building something, if there are problems with, let's say, with a home that's been built, you cannot blame the hammer. It's not the hammer's fault. It is the builder. Or if it's an excellent home, the tool can be a benefit, but it is not what built the home. Credit is the same way. Too many people will blame their credit or the credit cards or the credit card companies for mistakes that have been made, when it's just a tool. Just the same way that money is a tool. Money is a tool to reach our financial goals. So those are the 4 things that when you think about credit, think about it being a privilege, what it's recognizing in us, that it is an agreement. It has to do with our keeping our agreements, and that it is ultimately a financial tool. Okay, the first passcode for this presentation is credible, and it is all capitalized, C-R-E-D-I-B-L-E, credible. Okay, now what is on a credit report and what goes into a credit score? That's what we're going to talk about right now. First of all, a credit report is essentially a record of anything we've done on credit. If we've had loans, then those loans will be on our credit. If our credit has been used for applications at work, which I'll mention that later, but more and more landlords are looking at credit reports, that will likely be on our credit report. It's the credit bureaus, or credit reporting agencies, as they are also known, that collect all this information, whatever we've done with credit in the past. They collect it and store it and make it available for legitimate business purposes. These credit bureaus are for-profit companies. They are not government agencies or nonprofits. They are in the business of collecting and distributing our credit information, and that is a legal business, and we, to a great extent, ought to be appreciative of what that has been able to achieve over the last couple of decades where we have gone from waiting weeks to get approved for a line of credit to being able to get approved for a line of credit very quickly. So the time frame is a very good thing. And that's not what's led to some of the problems in the recent past about loans being made to people who cannot or should not afford it. Those were not based upon the credit bureau's practices, but upon the lenders themselves and their benchmarks. A credit report can also be known or referred to by some people as credit history or credit record, credit file, or just plain credit. So if you hear any of those, it's most likely referring to a credit report. If it's the record of our credit, whatever we've done with credit in the past. But we will, for this purpose, talk about a credit report. So where do you get a credit report? For free. You can actually get one, and it is not advertised. The one that most of us and most of you are thinking about when you think, oh, I can get a free credit report, I'll just go to one of those .com websites. That generally is not free. They generally will require you to sign up for a monthly subscription service that can be $10 or $15 or more a month, and that is often not necessary. To get your free, no strings attached, no credit card required credit report, go to annualcreditreport.com. Back in 2004, a federal law went into effect that mandated that we can get a free credit report from each of the 3 main credit bureaus every 12 months. So we can get 3 credit reports a year. We can get them all at once. You can get them one at a time. We generally suggest that about every 4 months you get your credit report from one of the different credit reporting agencies, and just review it for accuracy, which we'll refer to a little more in a few moments. Annualcreditreport.com. Just note that down and share it with family and friends so that they're not paying for a service that they don't need when they can get this credit report for free. Okay, what's in a credit report? Okay, let's start off by talking about your identifying information. It is just that. It identifies you as an individual. It'll have your name or names. If you have a maiden name that you've maybe applied for a loan under, it may also have misspellings of names. And if there are misspellings, don't worry about it. If it's still most likely you, it's just that that means that a lender that has reported to the credit bureau in the past may have just misspelled it or miskeyed your name. It may have your Social Security number on there. Some credit reports will still have that. Your credit report that you request from annualcreditreport.com will give you the option of whether you want it on there or not. But it will likely ask you for it in order to identify you. It will have your most current address and quite likely fairly recent addresses, and those can be spelled many different ways. Generally, it'll have probably have your telephone number. It may have your driver's license. It may have your marital status and even your spouse's name. Some credit reports, depending on what they're used for, will not have your marital status. For example, when employers are looking at your credit report, their version will not have your legal or marital status because they can't make decisions based upon that has anything to do with that. So, identifying information. The next section will be an employer information. It may or may not be updated or too accurate, but it will have information on who your most recent employer is that requested credit or report or reported to the credit bureaus. But it does not have anything to do with your income. It will not have income on your credit report. That's one of the myths out there, is that if you have higher income, it may help your credit. If you get a higher salary or something like that. Credit scores, particularly the most common ones by Fair Isaac Company, or shortened for FICO, FICO, does not take into account salary or income at all whatsoever. It's nowhere to be found on your credit report. The most influential portion of any credit report is this the credit lines and loans. And it may actually also break it down into another section of collection accounts as well. But this is where it shows who you've borrowed money from or who you owe money to in the last 7 to 10 years. Even if you pay off an account, it will still stay there for the next 7 years from the last date of activity. So from the last time that a bill was sent out or the last time that you made a payment, any negative information will stay there for 7 years. Generally, positive information, on-time payments will stay there for about 10 years. This will have all the details of each of those accounts from the date that it was opened to the initial amount of the loan, if it was a home loan or a car loan or a student loan, to the current balance. It'll have the terms, what the monthly payment is, if it's a specific, if it's an installment loan, what the dollar amount of your monthly payment is, or if it's a revolving line of credit, what the percentage of the payback terms are. And then most importantly, it will have a history of your payments. It'll show for the last 12 months, sometimes 24, on the report. It actually show have they been on time, or it'll mark the months if a payment was late and how late. If it was 30 days late, it'll have a 30 underneath that month. If it was 60 days, a 60, and 90 or more, it'll have a 90 plus. So that is, as you'll see, the most influential part of your credit is your payment pattern, because it goes back to responsibility of making payments on time and that character portion. So details of our credit. Now, even when a creditor you may close an account if it's been paid off, or they may sell it to another creditor, that account will remain on our reports for, again, 7 years from the time that it is of the last activity. And most credit reports that you'll get, particularly for if it's for you, if it's not through a lender, but if it's a report that you request from one of the credit bureaus, they'll generally give you information on when that item is scheduled to drop off your credit report. The next, another portion, and these sections are in different orders depending upon the credit reporting agency that you are requesting the report from. But another section is the public record, and this is where you will have information on certain liens, on if you've ever filed for bankruptcy or if you've had a judgment against you in court, perhaps a garnishment. That sort of information will be listed in the public record, and that generally will stay for different lengths. But bankruptcy, for example, will generally stay for 10 years. Certainly, if it's Chapter 7, it'll be on your credit report for 10 years. Chapter 13, which is a kind of a repayment bankruptcy, it's Experian generally will keep it on for 7 years, but the others for 10. Now, inquiries is another section, and they're not all. What an inquiry is, it's a request by a company for your credit to look at your credit report. But not all inquiries are equal. Some inquiries might affect your credit or credit score, and some may not. They're called hard inquiries or soft inquiries, or they may also be known as active inquiries or passive inquiries. A hard or an active inquiry is what that entails is when you actually are applying for a line of credit. Let's say you apply for a credit card or a car loan or home loan. That lender is going to pull your credit report, and by pulling their credit report, they have just created an active or a hard inquiry on your credit report, and it doesn't affect your credit score generally too much. Most people who hear about this are way too worried about that, about inquiries. Generally, they have a very small, particularly if you have good credit, they have a very small impact on credit. Now, if it's somebody else that's pulling your credit without your permission, which is quite possible if let's say a credit card company is looking to pre-qualify you for an offer that they want to send you in the mail without your request, or as I mentioned, an employer or perhaps a landlord, property management. If they're pulling your credit, those are soft inquiries. You're not asking for a line of credit. They do not impact your credit or credit score in any negative fashion at all. The last section of a credit report is the personal statement. We each have the right to add generally a personal explanation for a certain account or in general. We suggest generally that you do not add a personal statement to explain accurate information. And what I mean by that is if you made a late payment because you were out of town on a trip, don't add a personal statement saying, I just missed it this month. I generally am good. I was out of town. Personal statements are not taken into account on a credit score. Therefore, human eyes only. When a lender is specifically going to look at your credit report, what they're looking for, what we suggest you use that personal statement for is for explaining errors. Particularly if you're trying to get an error removed, that you're disputing errors that are really hard sometimes to fix, like having the same name and living in the same area as somebody else who might have a collection account or a bankruptcy or something like that that is reported on your credit report, and you're trying to get it removed. You might include on there a statement, so such account belongs to somebody different than me. Or we've heard that in the case where a father or son might have the same name, you have a junior and senior, and each other's accounts might show up on the other reports, and so you have to go through the dispute process. You might want to indicate something like that, so that the human eyes that are looking at that might say, oh, okay, well, let me take a look at this account and verify that is true. Okay, now all that information on your credit report is data, and it can be extracted and it can be fed through a program and come out the other side in a number, and that number is the credit score. So you've got the credit report, which is the data or the information on a report, and then you have the credit score, which is a representation as a number of you as a credit risk based on that information on your report. Now, the most common credit score by far is the FICO score, FICO. Stands for, as I mentioned, Fair Isaac Company. They were the pioneers. Mr. Fair and Mr. Isaac, literally, were the pioneers in the credit scoring business. There are other credit scores out there, particularly it's called the Vantage score, which has been created by the credit bureaus themselves, which has gained some in use and popularity, but FICO is still the most common. But there are hundreds, if not thousands, of different variations of credit scores, though most are based upon the FICO, the model. Now, there is no such thing as a perfect credit score. A lot of people get hung up on getting a better credit score or a perfect credit score. A credit score is an indication of you as a risk to a lender of defaulting on a loan. Meaning if you have a high credit score, the higher the better. The higher means the better. In this case, if you have a high credit score, you are less likely to default on a loan. That's basically what it means. So that if for example, you look at your credit report, this program will look at your credit report, and if you have several late fees or late payments on it, or maybe collection accounts, they'll take that as your past experience and basically say, well, according to past experience, this person in the future will continue to behave the same way, and so they have a lower credit score because they base this projection on past experience. So there is no such thing as a perfect credit score because there is no such thing as no risk. Anytime a lender makes a loan, there is a potential, no matter how much income or how perfect this an individual has paid their debts back in the past, there is a potential for them to not make a payment in the future, whether for health-related issues or just a decision not to make a payment. So, and very few even get near the top end or even the low end. It's hard to get a score. I don't think I've ever heard of a credit score in the 300s. Even for people who have filed for bankruptcy, generally are going to be in the upper 400s to low 500s with their credit score. So here's based on information from in the last couple of years, the distribution of credit scores nationwide. As you can see, about 40% of all credit scores are in the range of 750 on up. And that means basically that about 4 out of 10 people have excellent credit. And by excellent credit, all we mean is that somebody with excellent credit will generally get approved for the best terms available by the creditor. That does not mean they're going to be approved, particularly for installment loans or a car loan, home loan, because it's not just your past experience on those cases. They're also looking at income and what it is that you're buying and how much you're borrowing. But for credit cards and for other lenders, if you have a 750 on up, you're generally going to get approved for their best offers, their best terms, the lowest interest rates. It does not mean that you will, because every creditor is a little different in the way that they look at credit reports and credit scores. Some of them require higher credit scores to get their best terms. Some of them require a little lower, but generally 750 on up. In the recent past, it may have been just about 720 or 725 on up. But with some of the struggles that creditors have had to go through with so many defaults, they've generally raised their thresholds to about 750 or so. And as you can see, very few people down on the left-hand side have a credit score below 500. But anything in between that 550 and 750 is going to be mid-range credit. On the lower end, you're going to end up paying a lot more for any account that you do get approved for. And if you do get approved for a home loan, you're going to end up paying a lot more over the life of the loan if your credit score is low, because your interest rate will generally be much higher. Now, if you do when you do pull your credit report, I'm going to say when, because I highly suggest that you do pull your credit report regularly. Look at it carefully to make sure that you recognize the accounts and that the information and the data look accurate. It may not be exactly up to date. If you make a payment on a credit card today, it does not mean that it's going to show up in your credit report today. It may take up to a month or even 3 months for payments to show up on your credit report. Creditors only report your information generally once a month, but sometimes they can take 2 months or even up to 3 months to report that information. So it's, just keep that in mind when you're looking at the data, that it may be as much as a month old or so. The main credit bureaus, the 3 credit reporting agencies that are the largest, are TransUnion, Experian, and Equifax. And those are the 3 credit bureaus where you actually get to get a free credit report. Don't go directly to their websites for that free credit report. Go to annualcreditreport.com, because if you go directly to the website, they might say get a free credit report, but they were going to try and sign you up for a subscription service, and they'll take your credit card, and they may charge it shortly. Now, look for errors. Look for inaccuracies. And you can go to the credit, then if you do find an inaccuracy or an error, then you do go directly to those credit reporting agencies' websites, and you look for error dispute right on the front page. Generally, we'll have that. And it's a fairly simple, straightforward process, and it can take about 30 days to complete. But it's pretty simple. It may not be for simple errors. Sometimes it may take longer, and they might require you to provide a paper trail. But for basic, simple errors, it's a very straightforward process. Now, about this time in our presentations, the question of, well, what about hiring one of those companies that advertise all over the place on the radio or online, or get all those emails, or that they can get negative information removed from your my credit report. Now, keep this in mind. And some of these companies may be set up as nonprofits, or they may even be attorney offices. It doesn't really matter. What they're trying to do is take your money for to provide a service that you can do on your own. Some of them charge hundreds or even thousands of dollars, and what they'll do is request an item. They'll dispute items on your credit report, and some of them figure that if they do it frequently enough and bombard the credit reporting agencies often enough, that information, that an item of information might be removed from your credit. Now, here's the thing. Just because something is a negative piece of information on your credit report does not mean you can get it removed, even if you pay somebody to do it. Negative information, if it's accurate, by law, will stay on your credit, can stay on your credit report. You may get it removed. One of these companies, you might pay them, and it might get it removed for a week or a month or a little time longer than that, but it can come right back on your credit report once the creditor is able to recognize that negative information actually is accurate. So just because something is negative does not mean you can get it removed. If it's accurate, it stays there. What you're removing, what you want to remove, is the inaccurate information. Okay. So make sure you keep that in mind, because there are those ads all over the place that are going to try and charge you money to do something like that. Okay, let's talk about what goes into a credit score, an actual credit score. Now, FICO, as I mentioned, Fair Isaac Company, they're the pioneers here. This is their a model that they promote fairly ubiquitously all over the place. The main, as I mentioned, the main factor in your credit score is that payment history. 35%, the largest chunk of the credit score, comes from have you made the question, the answer to the question, have you made your payments on time recently? Now, if you've made a late payment, it's going to hurt your credit score. Now, the further in the past that late payment gets, meaning the more you make your payments on time and that you have been doing that recently, the less that late payment will hurt. But it does take into account for up to 7 years. After that, the next largest portion is your balance to limit ratio. This is not the same thing as a debt to income ratio. That is a mortgage term. When you're looking at buying a home or perhaps a car, those lenders are going to ask you about your income, and they want to know how much debt you have in relation to your income. Those are for secured loans. For anything that is based on a FICO score or an unsecured debt like a credit card, they are not going to be asking you about your income. Remember that that's nowhere to be found on your report. What they want to know is what they're looking at is your balance, your credit balance. They take how much credit you have outstanding, all that balance that you owe on credit cards and so forth, and they compare that to your total possible limit. Let's say you have a credit card that has a $5,000 credit limit, and you have maxed it out at $5,000 or $4,995. Essentially, you're maxed out. So if that balance to credit limit ratio is close to 1, that hurts a pretty large portion of your credit score. Now, they look at it, generally they look at it by each individual credit card or credit account and as a whole. It's not just one or the other. They'll look at it both ways. But the lower you can keep your balance in relation to your limit, the better. I've heard it anywhere from 50%, never go above 50%, to never go above 30%. And that's because even if you pay it off every month, if you make that payment the day after that your information gets reported to the credit bureau, for the next month on your credit report, it's going to show that that you have that outstanding balance that might be, even if let's go back to a $5,000 credit card limit. If you had $4,900 on there, and it gets reported to the credit bureau, and then the next day you pay it off that $4,900 to zero, still for the next month it's going to show that you were up pretty much maxed out on that report. So that can affect your credit score, and that's why we say generally if you're getting ready to buy a home or a car, make sure that you stay below 30% of your credit limit. If you are not getting ready to make a major purchase on credit, if you're not getting ready to buy a home or a car, don't worry about your credit score. I'm going to repeat that. Too many people fixate on their credit score. Unless you're getting ready to buy a home or a car or make another purchase on credit, don't worry about your score. It's only important, generally important, when you are applying for a loan. What you should focus on more than your score is, are you making your payments on time, and are you staying away from your limit? So avoid maxing out your credit and make your payments, all your payments on time, and if you can, in full. Then after that, 15% is how long have you had a credit card or a credit account? The longer the better. And this is, again, even if you close an account, it's going to stay on that account, on your report for 7 years. But generally, try and keep open the longest, the oldest, and credit account in good standing, and that'll help upwards of 15% of your credit score. The pursuit of new credit, that's referring to those inquiries. It might affect up to 10% if you have a lot of active inquiries or hard inquiries on your report. And then that last section, the credit mix, that's where the credit score looks at the types of accounts that you have. Generally, to get all of those points, you might have to have a couple of revolving accounts, a couple of credit cards, an installment loan, a department store card. But again, don't worry about that. You can still have very good credit even without the ideal mix that they're looking at. I have heard of people who say, well, I have to go out and get another credit card just because I have to max out that portion of my credit score. And that kind of goes against the whole idea of being a responsible borrower, which really is what a credit score is all about. Okay, let's talk briefly about what interest is, because you can't talk about credit without bringing in the idea of interest, because interest is what credit really affects. Think about, and when you hear the word interest, obviously it is a percentage-based fee of generally of the balance owed. That's what we pay in addition to the principal that we borrow, whatever it is that we're making a payment or borrowing money for. Anything above and beyond that price is what is basically interest, fees, and charges. And it's generally based on a percentage of how much we owe. Now, the way I'd like you to look at it is think about interest as rent on the money that you're borrowing. Because too often we think we get a loan, and I think back to my days in college, and I got my first student loan, and I remember seeing a balance in my checking account when that got deposited, and I thought, whoa, and this is a college student who generally is used to being pretty poor. Wow, $2,000, I'm rich, because I thought I now own $2,000. But instead of thinking about that way, just think about it like a home or an apartment. I didn't own that money, just the same that I didn't own the apartment I was staying in. I was only there, and all the money at the apartment, renting it. And every month, all the rent that I paid went to the landlord, not to me. I didn't get any of it back, the rent back. If I was good, I probably got a little of the security deposit back at the end, but I did not get any of that rent back. And the same thing has to be said for borrowing money. When you borrow money, all that interest goes to the owner of the money, which is not you, it is the lender. So think about interest as rent on money. We don't get any of the interest back. Every month, all that interest goes directly to the owner of the money. Because if we think about it as somebody else's money, hopefully we're more likely to take care of it and not spend it on frivolous things or things that are not important or that it's not meant for. And that was my problem when I got my some loans in college, is that I thought it was my money to spend, and really I'd forgotten I had to pay it all back plus interest, and what all that entailed on how expensive that was going to be. And interest is generally related to risk. Again, if you're high risk, you're going to have a low credit score, and you're going to pay higher interest. High risk, high interest. Think of it that way. If you are a high risk, you're going to pay high interest. Now, whether it's your interest is fixed or variable, when it comes to a credit card, generally it doesn't matter, because if you make your payments on time and in full every month, you won't. Most credit card companies will provide a grace period, and you will not have to pay interest at all. They'll look at making their fees from transaction fees and other fees that they charge to the merchants and to other borrowers. But if you make your payments on time and in full every month, you generally will not pay interest on a credit card, most credit cards, unless you are a high risk, and then they'll generally look at charging other fees. Now, when you hear those commercials that say, hey, come on down and get a low APR OAC, or no interest for a year, what do those actually mean? Think about it this way. Okay, OAC, first of all, APR, annual percentage rate, that's the interest rate. So the higher that APR, the more interest that we pay. OAC basically is that advertiser's way of saying not everybody is going to apply it. It stands for on approved credit, OAC. It means most people that go down and try and take advantage of that, a lot of people go down and try and take advantage of that are not going to qualify for those best terms. They're going to qualify for something maybe, but it might be at a higher interest rate. Now look at those ads that say no interest for a year, or nothing down, no interest for 3 years. Be aware that such campaigns often include the stipulation that if the entire loan is not paid off by the end date, then the lender will go back and add all that back interest from day one as if there were no original offer. Quite often these are associated with things like a furniture stores. And there's sometimes those interest rates are in the mid-20s, so that after 3 years, if you haven't paid anything off in 3 years, that $5,000 payment, original $5,000 purchase. Well, let's look at it this way. Let's look at this. Okay. Let's say you make a $2,000 purchase of some furniture. It might be some a bedroom set. For 3 years at 25% annual percentage rate, 25% APR. Okay. If you were to make monthly payments, let's say you got that no interest, no payments required for 3 years, but you told yourself, I'm going to be disciplined, and every month I'm going to make that payment so that in 3 years I pay it all off. Those would be $55.56 a month payments. And you'd have it all paid off, and you will not have paid any interest. Now, if you were just to pay normal interest, if there were not that offer for no payment, no interest for 3 years, you'd be paying $80 a month pretty much. And so at the end of 3 years, you'd have had to pay off $2,880. So an extra $880 just in interest. Remember, rent. That's 44% difference. That's a lot of money. But even worse, if you go with those no interest, no payments for 3 years, and you don't make the payment on time or at all, at 3 years, that immediately bumps up from $2,000 to $40. It goes back, adds all that interest, and now you're looking at over $4,200 that you owe. Just immediately upon the end date of 3 years, they're going to add another $2,233 in interest. That's a 112% increase overnight in the balance. So that's the danger that we're trying to make sure everybody understands about going into and getting those loans that say no interest, no payments for a year or for 2 years or 3 years. It sounds great if you are disciplined. If not, and you wait until that end comes around, you're going to get hit with a huge surprise, and not in a good way. So the main thing we want to remember is interest never sleeps. Interest is always building. Even if a company says no interest for a year or for 3 years, it's still building, and if you don't pay it off, it's going to wake up. So interest never sleeps. So I guess the question is that a good thing? Is it a good thing or a bad thing that interest never sleeps? And usually the answer that we get is, oh, it's a bad thing because we've just been talking about how it can build and how much extra we'll have to pay. But don't forget that if we are taking advantage of interest ourselves in savings plans and investments, then we're actually building income overnight. Instead of waking up, going to bed one night owing a certain amount of money and waking up in the morning owing more money because interest has come along overnight and added itself to our debt, if we are taking advantage of savings and investments, we wake up in the morning with more money in that account generally than we went to bed with. So second thing to remember is make sure you are making interest work for you and not against you. Make interest work for you through saving and investing it rather than borrowing it and paying it. Okay, here's the second of the 3 passcodes. The word is clout, all capitalized, C-L-O-U-T, clout. Okay, now let's talk about some of the basics of credit and credit cards particularly. Let me ask you this question. If you're driving down the road, you've got your car, you look down at the speedometer, and it goes all the way up to, in this case, it goes up to 200. That might be 200 miles an hour. Does that mean that you should be driving 200 miles an hour everywhere you go? Obviously not. We have to take into account the conditions of the road, the safety features, safety factors, and laws. It's very similar to the idea of a credit card limit. Too often, especially young people who get their very first credit card, they're told by the credit card company you have a $2,000 credit limit or a $1,000 credit limit. So what does that person do? They go out and they max out the card. They said, oh, I can go out and spend $1,000 or $2,000. And I'll be honest, that's what I did. I was one of those who was not very smart with my very first card. That $2,000 credit limit on that card, within 36 hours it was maxed out. I was thinking that I can go out and speed because that's my speedometer said I can go that fast, rather than thinking, okay, what should I use it for, and what's it going to be like, what's going to happen when I have to pay it back, and how much more am I going to have to pay in addition to that. So make sure that you and your family members or friends that are getting credit cards understand how to address the limit and to stay within a budget. Now let's talk about minimum payments, how they work. For some reason, they used to be some sort of a mystery to me how payments work. Minimum payment it changes every month. Every time you get a statement from a credit card company, they're asking for a different amount. Essentially, in simplistic terms, now this is not exactly true, but generally what you can say about minimum payments, because every credit card company, they're all going to look at them a little differently, but generally it's a percentage of how much you owe. If you take your balance, what you currently owe, and you multiply it by anywhere generally between 2 and 5%, that's how they figure out what the amount is that you owe. So if you and here's the problem is some people think, well, I got a credit card that has this is a lower monthly minimum payment. This is great. I don't have to pay as much every month as if I got compared to another card that I could have gotten. That's actually not a positive thing. That's a negative thing. The lower the minimum payment, the longer it takes to pay it off. That's the fact of life. If you only make minimum payments on a credit card, let's say you have a $2,000 or $4,000 balance on a credit card, if you only make the minimum payments on it, it can take, and never use it again, it could take as many as 20 years or more to pay off that debt. Every month they're going to be asking for a little less, a little less, a little less, so it's just barely covering your expenses, your interest. And so most of that, 90–95% of your minimum payment is only going toward your interest expense. Something else to be aware of: avoid cards that have a lot of fees, or avoid doing things that will incur a lot of fees. Make sure that if you're getting a credit card, unless you have really poor credit, you generally should be able to find a credit card that has no annual fee. Now, some of the exceptions to that are if you're looking at some sort of a credit reward, travel reward cards. Those generally currently have annual fees. But if you're late on a payment, they'll charge you a fee. If you go over your limit, and with the new law that went into effect in 2009, you have to opt in to the ability to go over your limit. If you do go over your limit, there's another fee. If you transfer a balance from another card, there's another fee. If you bounce a check, there's a fee. If you lose your card, you might have a card replacement fee, or you want a second card for your other wallet, there's another fee. If you get a cash advance, or if you pay by phone and talk to somebody, a person, and make your monthly payment by phone, there's another fee. Some will have activation account fees. The fact is, if you're not careful and you don't understand what all the fees are, I knew somebody who had applied for a card only for emergencies and did not realize that there were a bunch of fees associated with that account, that there was an activation fee, there was an account registration fee, there was a membership fee, and a maintenance fee. She never opened up the bill. She just assumed, hey, I haven't made any purchase, I've never used it, and within a year there was a $1,000 balance on that card because of all the fees and all the late fees that get added every month until she made that full payment. So be aware of fees. I mentioned the grace period. Of course, as I mentioned, if you make your payment on time and in full, most cards have a policy that they will not charge you interest. Now, if you carry a balance over from one month to the next, even if it's just a penny, there will be generally immediate interest starting to charge on every single purchase. Or if you get a cash advance, or if you use what they call the convenience checks they'll send you in the mail. They look just like a normal check, and they say you can use this just like a normal check, whether to pay off another creditor or to pay your brother-in-law. Anybody that accepts checks can accept these convenience checks, but they generally will carry immediate and sometimes higher interest rates than your normal purchases. And they will immediately cancel any grace period that you qualified for previously. Be aware that some cards still practice universal default, whether directly or indirectly. Basically what that means is if they see that another card company reports you as having made a late payment, now you are a higher risk. And so they're going to assume, oh, they made a late payment to another card company, we might be next, so they might increase your own interest rate universally. That's basically what it refers to, is that even if you make a payment to a different credit card company, that credit card company can raise your interest rate. Now here's how. See, that's part of the new Card Act of 2009, kind of trying to get rid of this. But the fact is, if you make a late payment to another card company, that increases your risk, changes your credit score, it lowers your credit score because now you've made a late payment, and even indirectly, there is this already the idea of universal default, so that they can, if your credit score goes down, they can still choose to increase your interest. All right. Other options, be aware that if a company offers you a payment holiday, and particularly around November, December, around Christmas time, a lot of card companies will send letters out to some of their card holders and say, we know you want to buy some gifts for your friends and family this year, and you might be having a tough time, so we're going to allow you to skip your payment and not charge you any late fees. Okay, they may not charge you a late fee, but remember that whole idea that interest never sleeps. They will continue to charge interest, and since you're not making a payment, your balance is higher, so your interest is going to go up. Your interest payment, the amount of interest you're paying. Not the rate, but the amount. Some other things to keep in mind, particularly with regards to, let's talk about college students. 60% of college students, and I think this is going up every year, if they 60% of college students who have a credit card will max that credit card out their freshman year. So if you think it's a good idea, if you have kids going off to college and you think, well, it's a good idea to give them let them have a credit card for emergencies, unless they are very responsible and they can tell you what an emergency is, that it is not running out of soda or other beverages on the weekend, or it's not having enough money to go out to a movie on a Friday night. A lot of college students start thinking of social emergencies rather than of physical, running out of food or having to get home for some reason. So a lot of people, some people are proponents about having college students use credit cards. I think it depends on the college student, but generally college freshmen are not ready to carry their own credit card. Another statistic that is eye-opening, U.S. households pay around $1,100 a year just in credit card interest, just in the interest. Remember that rent that they're paying on the money that they borrow. $1,100. That means that that's $1,100 that the credit card company never has to lend out. That's what they collect. So that's their profits. And then remember that a lot of these prepaid cards that are out there making advertising themselves as their alternatives to credit cards, be aware that they may have lots of fees associated with them, here's an example of a problem with credit card. Some of the prepaid credit cards, they might seem safe, but they might have a very high transaction fee. So let's say you make a purchase for whether it's $1 or candy bar, or whether it's a television for several $100s. That transaction fee might be the same no matter what. It might be $1 or $2 or $3. So it might, if you're only buying a candy bar with a prepaid card, basically you're just doubling the cost of that smaller item. Okay, so now who's looking at your credit? We mentioned this before. Be aware that it's not just lenders. Obviously, home lenders, auto lenders, credit card companies, anybody you're applying for a loan from is going to be looking at your credit. But as I mentioned, landlords, they want to know, has this person made their payments on time in the past to their financial responsibilities? Because if they're not making payments to their creditors, it's quite likely that they won't make their payments on time to me as a landlord. So they want to know what the possibilities are, what the person's credit score is. More and more employers, particularly if in certain government agencies or in the finance sector or in security, they are definitely going to look at an individual's credit and may take that into account in a big way if an individual does not have good credit. A lot of insurance companies, homeowners insurance, car insurance, life insurance, they're looking at your credit report. They might call it by a different name, but essentially what it is, it's a credit report, and they may either deny the individual or they may charge higher premiums, depending on what they see. And oddly enough, why can they do that? Why does a car insurance company, why can they charge higher interest rate or a higher premium for somebody who has poor credit? Because there is, oddly enough, can't argue with the data in this case, there is a definite correlation between somebody with poor credit and the number of accidents and claims that accidents they get into and the claims that they make. I don't know why, but that's the way it is. Utility providers, cell phone providers, they're going to look at credits. Now, utilities can't deny somebody a service, but they can charge a higher activation fee, a higher account fee. And cell phone providers, they can deny service based on somebody's credit. So here's the third passcode. It's contract. One word, all capitalized, C-O-N-T-R-A-C-T, contract. Okay, so let's just very briefly, to finish up here, let's talk about what to do. What if you don't have a major credit card, or if you want to live without a major credit card? Well, make sure you have a checking and savings accounts, and that handling them properly, you're not bouncing checks, and that your savings account is building. That does not affect your credit directly, but it is a part of being financially responsible. If you don't have a credit card, but you have made payments to a phone company or utility company regularly and on time, you can request that they report your payments to the credit bureaus. They may or may not, but quite often they will, and that can have a positive impact. It's not as positive as having on-time payments to a creditor, a credit card company, or other lender. Instead of starting with a major credit card, consider applying for a retail or a gas card, maybe a gas station or at a department store. Quite often it's easier to qualify for those cards, but they are going to generally charge higher interest. Just if you're going to do that, only do that if you're going to make the purchase anyway, and make sure that all the payments your payments are made on time and in full, because as I said, they're generally going to be in the mid to upper 20% range for their interest. Consider a secured card. It's kind of like a debit card. You open up a secured savings account, and they issue a card. It might be a bank that issues a card against that secured account. If you don't make the payment, or if you're late, they'll take the fees out of your secured account. They will charge you fees, and there are generally other fees involved as well. If you're doing that to build your credit, just make sure that you get it in writing that company is actually going to report your activity to the creditors, to the credit bureaus, because some secured card companies may not report your activity, and so it's not even helping you build credit. If you get a cosigner on a loan, that can affect your credit, but be aware that it will also affect the cosigner's credit. And if you don't make the payments as agreed, it will negatively affect the cosigner's account or their credit. And they will also be responsible. If it's for a car or a home, they will also be responsible for that payment. Now, how do you improve your credit score? Well, we mentioned dispute errors. Make sure you're living with a budget and not bouncing, not going over your limit. Stay under your 30% or so of your credit limit. If you're having trouble making payments, contact the creditor and work out a repayment plan. Don't ignore it. Don't apply for a lot of new credit all within a short period of time. That's those active inquiries, so you don't walk down the mall and apply for 3 or 4 different cards all in one night or even in 1 year. Keep it fairly minimal, 1, maybe 2 at the most a year, but generally 1 you're pretty safe. Shop for the best rates on credit cards. Don't close old accounts. Pay down your balances. Make sure all your payments, if you're late on any accounts, get them all current. Pay your bills on time and in full. And that will do it. I appreciate you being here with me, and hopefully you found some information of interest and benefit. If you have any questions, we are always available at the nationalfinancialeducationcenter.org or debtreductionservices.org, or give us a call, toll-free 877-688-3328. If you are taking this course for credit, please return to the website where this was listed and look for the corresponding quiz and submit that to us. Wish you all the best, and have a great day.